You weren't worried about your portfolio at breakfast. Then you open your phone and suddenly there's a recession warning, a tariff headline, a Fed prediction, 3 experts saying this time it's different. By lunch, you're suddenly questioning your entire financial plan. Most financial plans don't begin with greed, they begin with fear. Stay tuned to learn more of how to avoid this.
Welcome to a Wiser Retirement Podcast, where we cut through the noise and bring you real, honest conversations about investing, retirement, and building lasting wealth. No sales pitches, no gimmicks, just insights to help you stop guessing and start planning your financial future.
Welcome to a Wiser Retirement Podcast. I'm Casey Smith. Today I'm joined with Senior Financial Advisor Shauna Theriault to discuss if you're reacting to the headlines or sticking to the plan. Hey, Shauna.
Morning.
Good morning. Our world traveler has returned.
It's hardly a world traveler if it's like one state over.
I know, but did you not go to Epcot while you were in Florida?
I did not.
Oh, then yes, you just went to one state then.
I did not. Believe it or not.
Client meetings in Florida. Sounds horrible.
It was fun.
Probably a little warm.
Actually, it was raining the whole time.
Wait, were you in Florida this weekend? Yes.
Yeah.
I was too.
Oh, well, you're a world traveler then.
Well, no, I went by car.
Oh.
And pulling a couple of horses.
Oh.
So my daughter had a horse show.
You can't bring the horses on the plane.
No, not alive. Yeah, I was in Ocala, Florida.
Oh, I was close to you.
A horse show.
I was like Orlando,
So
there you go.
Who knew? I don't know. I don't know if Florida could handle both of us. That's crazy. There was no warning for them.
Right,
or anything.
exactly.
Good grief. So, hey, the book is launched.
Very exciting.
You can buy it on Amazon. I'm sure we've linked it to this podcast somewhere.
Yeah.
So check that out. We've got a few chapters in there. We did. Right?
Yeah, absolutely.
That was fun.
That was really fun.
All right. So let's talk about headlines that are built to capture attention. So I think that people are smart enough, especially our listeners, because if you're listening to this show, you're probably pretty smart, that news headlines are made to capture attention. Like there's not going to be a news headline that says the long-term investor is doing great still, despite the recent market turmoil. I've never seen it. The only time I have ever seen a person who only talks about short-term stuff break down and say you should just buy the S&P 500 and hold it long-term was Jim Cramer on CNBC during his show that comes on after hours in the middle of the financial crisis. Like Dow was plummeting through 8,000, headed down to 6,000. I think 6,500 was the low. I remember because I would just sit there and watch the TV going, what in the world is happening? Right. Just trying to make sense of it all.
Yeah.
And Jim Cramer broke down. I wish I could find it on the web somewhere, but Jim Cramer broke down and said, if you're a long-term investor, you just buy the S&P 500 ETF, you just hold it. They probably deleted that they probably paid YouTube to eliminate that. But
well, that's no different than any other headlines. That's, it's like whatever the fear or the scariness.
Oh, yeah.
That's what sells,
Yeah,
right? Like their job is the hook.
That's right.
So
that's right.
Yeah.
We have operations has moved into an old advisor's office. And so that's where Tiffany and Kyle share an office. And there's an old TV there. There's a new TV, but in an old advisor office, right? It's up on the wall. And instead of taking it down and there being just like these big bolt holes in the walls, like, we'll just leave it up. And I put it on Bloomberg for them or something. And then they quickly changed it to local news. So it sits on local news all day long. And then one day I walked in and it wasn't local news. It was like, I don't know. It was some show. I call it soap operas. they're not really watching
they're
this
not
stuff.
watching TV, no.
They're not really watching this stuff. But it was on and I said, oh, you changed it from local news. And they're like, all it is murders.
Right, exactly. Exactly. That's like, scary things or sad things is what sells, unfortunately.
Right. Yeah,
same in the financial discussions.
There's no headline there. It says, Martha walked down the street today and got a coffee and it's a really nice day. That's not what happens. It's not how you sell coverage. The same thing with our advertising. If you think about, like, for example, I know I don't know her personally. I've just seen her stuff out there in social media, but she's an attorney. Okay, that can mean so many things, right? She's not a tax attorney or anything like that. She's just an attorney. She went to law school, passed. Congratulations. But somehow she became like this financial advisor. So she's an attorney that's a financial advisor, and she's going to tell you what's really happening in financial services and how you should be investing your money. Most people think, oh, an attorney, ooh, and whatever. So the point of it is that the hook is that there must be something different. Like there's probably some secret that I don't know about. And I dig through her website. In the end, she's selling annuities. So she's out there going, I have something different. Aren't you tired of losing money in the market? Aren't you tired of this volatility? I have something different for you. This is, and it's not what you think it is. Because everyone goes, oh, it's annuities. And it's like, no, it's not what you think it is. And so again.
But yet it is. How is that not like a bait and switch?
Oh, it totally is a bait and switch. But that's how the marketing hook can work. It's kind of what we do is a little bit different. Our hook is like, hey, is your advisor just working on investments but nothing else? Like there's a whole other spectrum of financial planning that is not being done in entirety. It's being done in bits and pieces by our industry, but not done in entirety. Only 4% of us seem to be doing it in entirety. So it's and that 4% number, where did I see that I guess I was thinking from NAFA's website. You can go to NAFA.com and it tells you what percentage of people participate in fiduciary fee only type work doing comprehensive planning. But if we ran a bunch of headlines that were super negative, we could generate a lot of views and a lot of attention. And our advertising tends to be a little bit more positive than that, or talking about giving people confidence, right?
Yeah, we'll talk about the planning side.
But it's amazing if you want to go outright negative, you can get a lot of attention. Maybe that's what happens in politics too, because we see that during politics. Every candidate is saying what other person won't do, but they never tell us what they're going to do.
Right? Exactly.
Right? It's just like I think that resonates with people better, and maybe it's just human nature. But again, nobody's going to click on long-term diversified portfolio continues functioning normally in the middle of a financial crisis or whatever we have. But there's and I don't want to like poke fun at people, because in the end we're all susceptible to it, because it's human nature.
Yeah.
Human nature. We have normal biases. Some of them are like action bias, loss aversion bias, recency bias, the emotional comfort of doing something. Why staying disciplined can feel passive even when it's actually strategic. So it's like if your house is on fire, you do something, you get out, or you put the fire out, or there's action.
Yeah.
So sometimes doing nothing is not. It
doesn't feel right.
It doesn't feel right,
Yeah.
Even in aviation, when we're being trained to fly a commercial airliner and the engine catches on fire, you pause, you pull out a book.
Yeah.
You open up this book and you do step 1, step 2, step 3, because if you just react, you could do the wrong thing. You could shut down the good engine instead of the bad engine.
Yeah.
Right?
I mean, most reactions tend to be somewhat emotional. I mean, there's the fight or flight reaction, right? If we have to do something, so we're in a car accident. I mean, this fight or flight, that's not what we're talking about. So we're talking about a long-term strategic plan that was carefully put in place so that you don't have to be emotionally reacting.
Correct.
And that doesn't mean the emotions don't come if you see your portfolio going down or something happening. But if you react to that and say, go to cash or do something in panic, you can really hurt your portfolio doing that.
Yeah. That is correct. I'm thinking, I think maybe education solves a lot of that.
Yeah.
So if you can
like,
educate
what do we do
yourself,
in a down market?
Yeah.
What do we do when we have an up market? And,
right.
It's not the same on the upside too, right?
Yeah.
If it's like really, really, really high, you take your gains and you rebalance.
Right.
That's strategic in nature. That's discipline. If it's down, maybe you tax loss harvest or buy more or follow the plan and wait, so that isn't doing nothing is also an action.
Yeah.
It can be. It's a decision. So, that's where it's like you putting in place when things are going well, whether they're going well or going, you putting in place what your plan is what's going to get you over the long term during the downturns when they become emotional, to be like, wait, remember what we talked about, but you're right. It is education, understanding what to do. Cause some people just, we have the luxury, I'm going to say, that we've been in the industry and we've seen all these market cycles for the last, I've been at 29 years. I think you similar. So, and even if somebody's an investor, they've seen it too. So someone that has done this over time, they understand, and it doesn't feel as scary because we know that these things are coming. But, someone who hasn't really maybe paid attention as much or doesn't understand it as much or hasn't studied it as much for whatever reason, are new to it, it just feels different until they have that education really. And they've seen it play out in real life.
I had a client, her name is Nancy Christie. Nancy Christie passed away in 2020.
COVID.
But she was one of my, not of COVID, but just, kind of old age, actually.
During that time period.
But she was one of my largest clients in the middle of the financial crisis. Me being a younger advisor, probably 8 years into the industry at that point. I had to go do all these meetings. Your portfolio's down 20%, your portfolio's down 30%, your portfolio's down 40%. You're having these meetings just so draining, and you're trying to remain positive and say, this is what the market does over long terms, well, she did drive. She shouldn't have been driving. So I would try to go see her if I could. And again, client base back then was, 40 people, 50 people, somewhere in there. So you can spend a lot of time, thinking about different situations. And anyway, so I would go sit at her kitchen table, and I remember sitting as Miss Christie, this is the performance over the last year. I said, it's not really good. And I probably put my head down as I said it or something. And she looked at me and she says, it's going to be fine. No one says that, I'm supposed to say that to you. You're not supposed to say that to me. Right. And I remember looking up at her, and she's like, I lived through the tail end of the Great Depression. I said, she's like, we're doing fine. We're going to be okay. Everything's going to be fine. And I said, well, we're in index funds now. These are broad companies. She's like, but it's all going to be fine.
Like, can you train our clients?
Right.
That was during the financial crisis?
That was during
08 and 09?
Yeah.
Okay.
Yeah. So 7,
So she was with you for a long time.
Oh yeah. She was with the firm. She was at the firm back. So the predecessor of this firm was another company that I bought. Right. So she was with that company. So she came with the acquisition of Wiser in 2007. Yeah. So not only was she have so much wisdom and understanding of markets and how things happen, but she also was a new client to me. Yeah. And so she just and I remember for years, I'd go by and see her every quarter. I'd go by and see her, and we sit down, and I'd probably be there for 3-4 hours. And we probably talked about finance for 10 minutes.
Yeah, exactly. Yeah.
But yeah, she was real sweet. She used to always buy Christmas presents for my children. I think she was one of the first ones to hold my daughter when she was born. She's 18 now, so she had come to the house.
I love those kind of relationships.
But it's but she had already lived a long life at that point, and she had just had wisdom from that. Yeah, and she understood how markets work.
And I feel that because the longer I'm in the industry, the less fear that and you can be confident about that because you've lived through it and you've watched. Right. It's like, I used to sit across the table from clients, and it's like, well, in a down market, it's okay if you're retired. And of course, I've had people say, well, you're not retired, you have time. Yeah. Well, that's true. I'm not retired, but I've walked beside hundreds that have retired. Correct. And I've seen how it plays out in their portfolios. And so I've witnessed a lot of different financial situations. Right. And so
she's the polar opposite of a person that I said was not a good fit for this firm. And that relationship ended very differently. But it was a lady that would watch The View and get her investment advice from The View. And she would call me and say, well, The View says we need to be selling everything right now because, so-and-so is president. We got to be getting all our stuff out. And I'm like, I'm sorry, that's not even financial news. Like, I'm used to CNBC says, but not not the view.
Yeah.
Right?
Well,
and after I realized I wasn't calming this person down, I was like, this all needs is a good relationship.
yeah, market timing is not a good thing. Definitely
No,
not.
especially when it's based on politics.
Yeah.
Politics is a whole nother thing that's smoke and mirrors, right? So if you're trying to base your portfolio off politics, that is a losing game. It's not even a fair game for you. It's a lot like buying a car. You know, every car I've bought, we lost money on this one. You got a good deal. Like, there's no way you lost money on this car. You wouldn't be in business, right? You tell that to everybody that walks in this dealership. So let's kind of go through what I call a headline Hall of Fame. Every single time, clients would say, "This time it's different." Oh, this time it's different. And we and I both have been doing this for about 26 years. So we lived through a lot of this. Some of it's more recent than other times, but obviously I think I have to revisit this one first. Headline number one of this list is the 2008 financial crisis. I mean, that was the biggest. And it was long.
So it
was long 2 years.
Yeah, it was. So from start to finish, the market took 4.5 years to recover. But the longest time period is like the .coms and then into like 9/11. But you don't feel it the same because
that was the lost decade.
Because in the .coms,
Enron was in the middle of that too.
Exactly. So like you don't feel it as much because if you weren't really, really, really tech heavy, like people who were tech, because they were chasing tech, that's one reason to be, diversified.
Right.
Then it was, you recovered fine. That was actually a really long time period, but the financial crisis hit different because it felt like it affected everybody.
Right. Banks were collapsing.
Bonds were down. Stocks were down, which is usually that's the flip, right?
Yeah, then it started in the bond market and then it transitioned into the stock market.
Right.
It was a credit crisis.
But normally, if stocks are up, bonds don't go down as far, and that it was different in that. And then people were losing their jobs and people were losing their homes, and it felt very.
It was a 57% drop.
Yeah.
From the peak to the bottom.
Yeah.
During that time period. Many people believed that the banks are going to collapse. It's making another banking run. Didn't quite end up quite that bad. That was a tough time period because we had transitioned the firm from all stock picking. That's what Mr. Weiser had done, who owned the firm at the time, from all stock picking to using ETFs, exchange traded funds, which were fairly new at that time, a new investment vehicle. But what was shocking to me was he would use leverage in portfolios. And so we were deleveraging portfolios starting in.
He was using margin.
Margin, yeah. So we were deleveraging portfolios, kind of one client at a time back in mid 2007. So the deleveraging had already started, but for the clients that were still leveraged, you accelerate the way down. Like you accelerate. If you borrowed money and then you're losing that much that fast, you're accelerating the decline on that, and just like you accelerate the upside of the market. But I remember just sitting there going,
because you own more of it, because you borrowed against it, so
correct.
You own more of it.
That's right.
Yeah.
So but you get margin calls at some point.
Yeah.
Like if it comes down enough, you get margin calls. So we started getting margin calls on client accounts. I remember it was like all hands on trading.
Yeah.
Because we didn't have models back then. We weren't as sophisticated as we are, not nearly as sophisticated as we are now. So it was really like trade this account. And we worked people through it. In the end, everyone recovered, partially because, people were concerned, but a lot of people were concerned about their jobs. Less concerned about the portfolios.
Right.
In the end, everyone kind of came through it. But I remember one family that was really nervous about investing in that time period. And they're like, oh, I don't know about investing in the stock market. And they had a lump sum coming from a pension. So they're going from a cash type environment into the market. Well,
which that feels deregulated a little bit,
right.
like,
so I was like, well, we can't get your house paid off. You can retire sooner. He was in a job that required a lot of labor, but made decent money, had a large pension. It was a lump sum. And so we invested that lump sum, very nervously. Even I was like, I don't know. The Dow was around 7,000 when we put the dollars in, and we invested half of it, and the other half went in like 6 months later. Should have put it all in because that was Dow 6,500 was the bottom, and it was pretty much all up from that point on. And in fact, the rate of return on his very conservative account was enough to pay off the house. And that was a life lesson to me, is like, you can't time this stuff.
No.
You have to put the money in and just let it keep working. And also in 2010, so our rapid growth rate really started in 2014. We've been growing 20% per year as a firm since 2014. Prior to that, it was still above normal, but it was in that 8 to 10% range. 2010 was a really big year for us for growth. It was a lot of people who used to have $1 million who now had $500,000 because they sold everything. They were self-managed and they sold everything in the crisis. They will never, ever get that money back.
Casey, I watched somebody during that time period turn $7 million into like $3.5 million just from like a couple of trading days. It was there. I had this client that his income covered his expenses, didn't really have withdrawal needs, and had a lot of money invested in the market. And it wasn't even 100% in stocks, but at some point, 08 and 09 happened. It's like around the time where GE went to like 4. It's like when they stopped trading. It's like that's when they put in the stop trading and they halted trading to pause because it was going too high or too low going forward, you know? And so on that day called and said, I get me out. And I'm like, I don't recommend this. I tried to reference the plan and it was like, get me out. And so what happened after this? So we did with the client, I mean, it's the client's money. Yeah. You have to, I mean, I don't recommend it, but we did it. And so sold, of course, what did the market do? Straight up. And so then it's like, that's the problem. When do you get out? When do you get back in? And so he called again and it's like, get me back in, put him back in. Market dropped again. He called again.
Oh, geez.
He sold twice.
Wow.
You can't recover from that. No, you have to be in that upside. And he didn't even need the money right now or even in the next 5-10 years, but he couldn't stomach the decline. And it's like, that's where it's sometimes, even if a plan says it could be a little less conservative because you don't really need the withdrawal, but it's like, how do you react in those moments?
Right.
Because I'm going to reference the plan and we're going to reference these things. But I mean, I watched them turn their portfolio and cut it in half just from like 3 trading days. Reactionary, even though that we said we don't recommend it. It's like we have to ultimately do what the client wants. I mean, it's their money.
That's very true. Very true.
I mean, we can't.
I'm very fortunate that exact situation happened to me, but it happened to a person who I considered a friend, but it was also a client.
Yeah. So you could be like, hey,
don't
do this.
I told him, I said, if you sell right now, you'll never retire. You're going to work forever. So he goes, no, I can't handle it. I just can't handle this. I can't watch this stuff keep going down. I said, okay, then you need to drive up here to the office. I will cue the trades, but you're hitting the enter button. I'm not going to be responsible for this. And he got really pissed.
Oh,
he got really pissed at me for a couple of days, didn't show up to hit the enter button. And about a year later, we were golfing and he told me, he goes, I was really angry with you. But if I had liquidated that, I wouldn't be playing golf right now with you. I'd be working a second job or something.
Yeah.
He didn't have a lot of money, but he had enough. Does that make sense?
Yeah. Yeah.
And so anyway, he went on to create actually he was a very generous person, but he created a foundation, which we supported for many years here as a firm and helped a lot of people through his foundation and all that because he was able to stay, keep his head about him and stay in shape.
Not all financial advice is created equal. Available now. Everything your financial advisor won't tell you. An eye-opening book that reveals what's really happening inside the financial industry and what it takes to build a plan that actually works. Because what you don't know could be costing you.
Another headline was COVID in 2020. Now, this headline obviously happened a lot later from the financial crisis, right?
Yeah.
So in the financial crisis, I lost most of this hair, right? I don't have any hair. I lost it all then.
I'm sure it was because of that.
Yeah, exactly. So in the financial crisis, I learned a few things. One is we got to make sure our clients have
enough liquidity,
enough reserves. Yeah. And so that's when we really started ramping up financial planning. See, back then, most firms didn't do financial planning. They were just asset managers. And that's when I said, okay, we need to get heavy into financial planning. Asset management will be fine. But we need to make sure we're doing planning. And that's where their cash buckets came from, where we maintain cash. So when COVID hit, people would call up and say, well, I know this is really tough. Market's down 30% right now. you can stop sending my withdrawals. I got some savings. I said, I've got 2 years worth of your withdrawals and savings over here on this side.
Remember, this is why we have this.
And you said, you mean that money hasn't lost money? I said, no, it's sitting in an FDIC insured money market. And we keep it in those.
It's your paycheck.
Yeah. We keep it 2 years worth of those paychecks in reserve. Mm-hmm. Oh, all right. Well, send me my money then.
Yeah. Yeah.
And then we had another, so that was one segment. Another segment would call up and go, I know this has got to be temporary. Like, how do I take advantage of this? Mm-hmm. And that's why I started thinking, oh, wow, like all of our podcasts, well, we started doing podcasts in 2020, but all of our blogging and things and talking to clients is working, because instead of them being fearful, they're going, oh my gosh, this is an opportunity of a lifetime.
Yeah. Right.
It's down 30%. If I get in now.
Yeah. And interest rates are down. So let's refinance again and everything else, you know?
Right. Exactly.
Right.
Exactly.
So you start thinking more strategically. You're like, oh, this is an opportunity. Even in retirement, there's opportunities there.
Yes, correct. So and I remember in COVID, bonds were up. The treasuries were up. So we're selling treasuries for a gain, and then we're buying stock lower, and we had to rebalance 3 more times that year because the stocks kept going up that we bought, and they kept getting too heavily weighted in stocks. We had to keep on selling stocks, put it back in bonds. That actually was, honestly, I look back at COVID, other than not making light of the loved ones we lost during that time period.
Definitely not.
It was actually not that bad of a year, because we ended up with double-digit gains by the end of the year. I only had one client who was panicking. He was upset. And with them, I said, okay, we'll sell 10%. And then a week from now, if the market's down again, we'll sell another 10%. And I kind of worked him off the ledge that way. Yeah. So I'd rather just lose.
So he felt like he was doing something.
He felt like he was taking action and doing something. So I was like, well, he's going to feel like he took action. 10% of the portfolio, that he's never going to get that money back, the gains back, or recover the losses in that 10%, but it's better than him going to all cash.
And it's a smaller percentage.
Yeah, correct.
Yeah.
Yeah. And they weren't super happy with me in that process. My job is not to be liked. My job is to tell the truth.
Yeah.
And so I was just telling the truth.
Right.
And then the next year they asked to meet with a different advisor, and they did. And then they asked him why their return was lower than the benchmark. And he was like, because
you asked to
be sold during, you asked to sell the portfolio
right?
during COVID.
I don't understand that.
so anyway, but yes, it's they're doing fine, but
it's because we get amnesia during these times. These things happen again, and we forget how it felt, or what, you know, we forget, or you're in a different life stage, right?
Yeah.
Maybe you're not saving anymore, and now you're in retirement, or you're in a different life stage when it happens. So it feels different. It feels
different. I mean, at that time during COVID, I just looked at every employee that was here, and I said, look, our company is in great shape. We're in great shape. You guys are in great shape. You guys all have jobs. There's no one's getting fired or not fired, but let go because of economic reasons. I said, this is our Super Bowl. This is why people have financial advisors, is right now. So it's time to step up, put the extra hours in. Yeah. We kept coming to work, except for those who had children at home, because, you know, we all had to turn into educators during that time period.
Yes, I remember.
So
you know how hard it is to teach a first grader to read when you're trying to do like all the stuff, and you have 2 other kids.
Yeah,
and I'm like, I don't know how to teach her to read.
It's a nail in the coffin for some kids. They'll never know math, or they'll never know whatever. You know,
you skipped over this.
And then we send them back to school, and they're like, no, we're going to keep these remote learning days, you know, once a quarter. And I was like, this is crazy.
What are we doing?
So we were able to get through that as a firm, because I feel like we had educated so many people for so many years.
Yeah.
And then, you know, I will say there were a couple of people, one guy, I love this family. But they would call up and they would say, you know, tell us why we're not like moving to cash or not doing something about this right now. And I would repeat it. And then every week I would say something a little bit different, try a different angle. It's like you're a teacher, right?
Different way you're trying to,
you're like, well, if I say it this way, maybe they'll understand it. And then suddenly by like the 5th week, the husband called, and he goes, well, just tell me again why. I said, honestly, I've explained this to you from different angles, and it's my fault. Like I'm genuinely upset with myself that I can't articulate this to you. And I said, I'm not being a very good teacher, obviously. And he goes, no. Just tell me what you told me last week. And I want to hear that every week and I'll be fine.
You're like, let me write it out for you so you can read it.
Oh,
okay.
Oh,
yeah.
And so sometimes we do that with our newsletter. I said, I've said this every time, but people just want to hear it.
Yeah.
They want to feel better.
Well, if something's going on, we're like, okay, it's time to send out a mass communication too. We, of course, we'll get in front of our clients and call them and talk. And, we know the ones that get worried, but it's like when we see something, it's like, get ahead of it and let's address it.
The hardest client to work with at times is the one that says, I knew this was going to happen. And they're typically ones that maybe tend to be a little more pessimistic about things. Like, I knew these valuations are too high. I knew this was going to happen. I knew the market was going to sell off.
Yeah.
And it's exactly what financial news media does. Market's going to sell off eventually. Market's going to do this. The guy who called the stock market crash is now calling for like an AI crash. Back in 2008, he called the subprime crisis, like one of two guys. He's now calling for an AI crash, and he's missed it. He's totally missed it. There's, you could say maybe it hasn't happened yet, but basically his whole reasoning of an AI crash, and this could be a whole different podcast, but the summary of it is that the accounting of the AI companies is wrong. That they're going to that they're depreciating these devices that they create, the hardware companies. They're depreciating them too fast. That they say they have a 3-year lifespan is how they depreciate it, but really the lifespan is much shorter than that, or something along those effects, along the lines of that. But what actually is happening is those devices after 3 years, those servers, those chips are typically resold again. They come back, they're resold again to somebody else who doesn't need as powerful of a chip. So the lifespan is really 5 to 6 years. So he didn't really understand the tech, and then he's trying to call a crisis. So anyway, point is that you have to be really careful listening to these people. I remember one point over Christmas, I was reading an article about how growth investing is dead and value investing is the way to go in the future. And it was very convincing. It was a 2-page article in the Wall Street Journal. I was like, wow, this is very convincing. And so I sent that to a portfolio manager we had at the time, and he replied back and he goes, research the guy who wrote it. And I look up his name, largest value hedge fund in the country.
Oh, well, see, that's how, can you really believe what you hear then? Really, because it's like he's trying to put a spin on it to sell something.
That's my point.
Yeah.
Is that he's trying to sell his wares. And in the end, everybody who is at that media level is doing that. They're being paid to be there. It's like a lot of the people they're interviewing on CNBC, how this works, people, is you hire a PR company, you pay that PR company, and that PR company works the system to get you some airtime on CNBC. And you get there to be on CNBC and you're talking about this or that. You're talking your book in order to benefit yourself. The people from Stifel, the people from Edward Jones, and all these, they're talking their book. I think this is whatever is a really good buy. Well, they probably own it. And they don't tell you they own it or not. Sometimes they do. Sometimes they do. Mutual fund companies, I've always noticed that they almost always tell you. But these other large managed firms, they don't tell you that. So just you have to be very, very careful about where you're getting your information from. We tend to just focus on the raw data, and we focus on BlackRock, Vanguard, State Street, what some of their people are saying versus any one particular person.
Yeah.
Because again, they typically have an agenda. Headline number 3, inflation and rate shock in 2022. That was a tough year. Bonds were down because interest rates are being rapidly increased to try to take care of inflation. And stocks are reacting to that. So the stock market in a high inflation environment will initially be down, but eventually it'll rebound because they benefit from inflation in the end. Bonds do not.
Right.
So even
bond values go down.
Bond values go down. That's another year that we, for people who are retired, we did not sell anything from the portfolio from the live on. We worked off that cash bucket, the one we talked about we had during COVID, to have still have the same thing in 2022. But you haven't seen inflation increasing that fast in over 40 years. The Fed totally missed it. People in 21 were like, hey, what about this inflation thing? They're like, oh, inflation is transitory. Is that the right word? Transitory. Yeah. People are making t-shirts about it. The nerds are, because it's kind of funny. But that was kind of a nasty year. But in the end, if you had the perspective as a long-term investor, we did make adjustments to the portfolio prior to 2022, to be on the short end of the bond market, meaning that the bonds would mature faster. Yeah. So as the rates increase, you're getting higher yields. Yeah. And then you want to reinvest your dividends, your income back into those bond funds to be able to capture that. So all that was happening in 2022. 2022 also was like a death by 1,000 paper cuts. There wasn't any like big 1,000, 2,000 point down days. It was more just, I felt like it was just down $500 or 500 points a day for almost the whole year. That's what it felt like. Yeah. Yeah. But again, if you reacted to that, you would have missed out on a tremendous rate of return in the end. 2023, it all came zooming back. 24, 25, 26. Yeah. And you're still sitting on the sidelines because, oh no, this is stocks are overvalued. Right. It's like so much of these headlines, people are reacting with emotion and fear. And honestly, I struggle sometimes looking at, are stocks really overvalued versus the P ratio and this thing called the Shiller index, which has been overvalued for 20 years. If you hadn't invested in 20 years, you don't have a whole lot of money. The last 10 years, the S&P 500 is up over 300%. Yeah. And you're telling me that you're an expert and you're going to sit on the sidelines because it's going to come down. What happens is, I've seen people do this. Market goes up. You're like, oh, it's really high right now. I'm going to wait to invest. Yep. It comes down, it has a sell off. You go, oh, it's soft. I'm going to put money in. All you did was put money in back at the entry point. It would have been in before, and you missed out on all the dividends. You missed out on all the income. Yeah.
Well, even still, if you would have put it in at that point, and let's say you have a blended portfolio of some stocks and some bonds, you could have still taken some gains off the table too and captured and put them in the bonds. So your overall value or your overall net worth could be higher and have the income from it, which adds to the net worth.
Correct.
Because then you're not spending from assets, you're spending from income.
So Vanguard did a study on this. You can go to Vanguard.com and you can probably search invest now or later. There's a PDF that should show up in that search. And basically it's very dry. I think it's like 100 pages. It's pretty long. But is it better to invest now or is it better to dollar cost average? So if you're investing in your 401k, you are not dollar cost averaging because you're investing 100% of that money the day you get it. Right. You didn't have that money prior. Yeah. Yeah. They're not paying you. Now, if you have a lump sum of money, so you have $100,000 or $1 million and you have cash, do you invest it all now or do you slowly work it in? So their study showed that if you bought at the high of the market every single time, you still came out better than trying to time it as it went in. Now, obviously, if you bought the low every time.
I mean, yeah, but you can't. You don't know that.
If you bought the low every time, you and I should go to Vegas.
Exactly.
I'll give you half my earnings.
That's what I tell people. If somebody tells you, I can tell you, this is what we're going to do and we're going to time the market. They're lying to you because if they could time the market, they wouldn't be working. Right. They're lying to you. Like they're lying.
Some of the biggest hedge fund managers have gone out of business over the last couple of decades over really bad timing. Buying things. Maybe they're ahead of their time, but really bad timing. So everyday investors, again, it's like, I guess it's like gambling at that point. So thinking about, do we invest right now? One of the biggest reasons for doing that is to get the income, to get the dividends. Well, that explains the lost decade, which is headline number 5 for us today. The lost decade narrative, basically you had the 2000 tech crash, you had 9/11, you had Enron, you had the financial crisis. So between 2000 and 2010, that was like the worst time to be an investor.
It was. And an airline pilot.
And an airline pilot. I was about to say it. I was like, no, I won't go airline today.
Sorry. I just, I always know that.
That was my decade in aviation. There was no upward movement.
No, right.
So it's the, during that time period, I remember looking back at portfolio reports and basically the price of the S&P was the same after 10 years.
Yeah.
But the income we got.
Yeah.
Was the rate of return.
Yeah.
and the income looked huge compared to the price. Now the last 10 years, it's been all price and the income seems almost like a footnote, right? But back then it's really all about income. That's where people started these whole strategies like, oh, we just buy high paying dividend stocks.
That's probably why it feels very similar to what your client was saying to you and I, because I started in the industry in 1997, right before the dot-coms. So I learned going in during that hard time period and watched everything that transpired and heard the conversations that were had and that, what actually worked during those times. And so now and we're never going to know 100%, obviously, but I feel confident in talking it through those times and then being able to say, well, I've watched how this works actually in this horrible downturn, and everyone was okay so long as you stayed invested and stayed the course.
Right.
If you started monkeying around or changing things or reacting, that's when things were not okay.
That's right.
The clients, and that majority of them stayed the course, and we referenced the planning, because I was doing actual planning all during that time period, because I started in this industry doing that, which I'm grateful for. And so, but I've watched it happen in real life. Yeah. And so your client that said, well, I went through the Great Depression. This is nothing. Well, I feel like we went through this downturn for that whole time, going into the industry and having those hard conversations and sitting with people going through this and holding their hand during those times. So when we have a pullback because a strait is closed, or we have a pullback because of whatever, I'm like, this is nothing. Yeah. It's okay.
It's opportunity typically.
Right. Or it's just like, great, let's harvest losses for a second. And, because most declines are less than a year. They pop quickly. Yeah. We've been through the lost decade. We worked in the industry during the lost decade, and that was hard.
I'm the president of Wiser Wealth Management, but I'm also the chief compliance officer, which is the most boring job ever. But I go through and I audit a lot of things. And typically I do this after hours because I can't do it during hours. But over the weekend, fun activity while my daughter's at the horse show, I was going through investment policy statements, and I was just looking at random investment policy statements saying this is how we should invest and this is how we are actually invested. And I was just comparing the two. And I kept kind of smiling as I was going through it, because almost all the models are greater in stock. Now, not out of tolerance. We don't need to rebalance, but not out of tolerance. But I'm thinking, who would have thought that? And I'm thinking of all the people that we've worked with in this, especially me that worked the last year, that hate President Trump, think President Trump's the worst thing ever. And I'm like, you might think the president's the worst thing ever, but look at your portfolio. And you just can't combine politics and all this. But this is what happens is like we put together a plan, and we've already back tested it to 2008. We know that catastrophe hits. We know that the client will be okay. It actually says 100% certainty on the probability dial, right? Yeah,
or 99 because it never says 100. Right?
No, but assuming that the rate of return, just the rate of return, that's 100.
Yeah.
But yeah, the Monte Carlo is like 99%. But what happens is people panic and they want to disrupt all that, just like your client that was, selling the market at the worst possible times. So they start panicking, and then that's when the whole plan gets kind of jacked up, because they just can't stand. There's something that triggers inside them that says, I can't stand this loss.
Right.
And if you can show them that there's multiple buckets, like you love the bucket system.
I love it.
You have multiple buckets, and you got cash right here, and then
that's your paycheck.
After 2 years, if that runs out because the market's down, you can go to bonds, which typically are going to be up.
Or not down as far.
True.
Yeah.
And you got 10 years probably worth in the bond fund.
Yeah. So between those two buckets, you have like
12 years of reserve. Yeah. And then you have stocks, which I tell most people, you'll never touch stocks except to take gains. Probably the stocks.
To fill the buckets back in.
Yeah. We'll fill the buckets back in, and the stock will go to the next generation someday. But if you don't put that in perspective, you can get really sideways. I tell it this way. It's like walking down the street. If you only looked at your toes when you walked, you're going to end up on somebody's TikTok reel or something, right? Yeah. Because you're going to run into a building, you're going to run into a pole, you're going to walk into a fountain. But that's not how we walk or how we drive. Some people might drive that way. But you don't look at the hood of your car when you're driving. You're looking out down the road, out down the sidewalk. And investing's the same way. You have to be looking out down the road. That's why I like having 1 to 2, 3% of digital assets inside a portfolio, because I'm looking down 10 years down the road going, there's probably something here. I don't want to risk
not
my retirement,
there.
but I also don't want to risk not being there.
Yeah, exactly.
Right? So it goes,
exactly.
you just a little dabble, just a little bit of salt, not the whole thing of salt, just a little bit.
Yeah.
Just a little bit.
Because we learned that in the .coms. You can't put it all
right.
in
Exactly.
like that.
So you just have to be really careful that you have a plan in place and you don't abandon that plan. That's why some people are more successful in real estate, because crazy things could happen in real estate, but it takes you at least 30 to 60 days to sell a house.
Yeah.
And so if you become rational at some point, where in stocks now you can sell it with a click. And then pretty soon in the next couple of years, NASDAQ, New York Stock Exchange moving to the blockchain, it's going to be 24-hour trading. So you're going to be able to liquidate your portfolio 24 hours a day.
After hours when you've had a drink and you're tired and that's not a good thing. I think.
I know.
I don't even drink, but I'm just saying, like, I can tell some of the people, because there's some people that will email you really late at night and you're kind of like, are they stressed a little bit?
I don't know. I joke with the young people here. I say, well, we're doing the night shift by seniority. So you guys will be working the night shift.
That's funny.
So disciplined investors are going to filter all the noise from all these things. And these are big headlines. There's smaller headlines. The Iran war is probably a smaller headline versus some of these other big ones we've talked about. But the disciplined investors are going to focus on that plan, focus really on a more diversified, using low cost ETFs versus individual stocks. They've eliminated company risk, right? So they're more worried about where the market overall is going to be, not where one company is going to be.
Right.
And then they're making sure everything's working together. So that's your estate planning, your tax planning, your insurance planning. All these things come together into one plan, which is what our job is advisors here at Wiser.
Well, just make sure you have the money to live off of to weather a downturn. That's the whole purpose of the bucket system. So it's like the market is going to fluctuate. The market is a long-term strategic move, but as long as you have, the money to live off for the 2 year, your paycheck, if you will, and then, maybe your fail-safe backup that's, if it goes beyond 2 years, or just to help with the overall risk of the portfolio, because you can't stomach those downturns too. So long as you're spending at a rate that is not, going to cripple you, because if you're making huge, large withdrawals and you're spending too much, that system doesn't work either.
Correct.
So long as you're spending within your means, which most clients that have saved have spent within their means, that system works. And so you can really, that doesn't mean that it doesn't feel uncomfortable when we watch our values go down, or, when things are happening in the world that make us nervous. But, once you've been through a couple of these declines, especially in retirement, because that's when I feel like clients feel it the most. It's like, I don't have time anymore. I don't have time and I'm not adding money anymore. And it's like, but there's other moves you can make, so it's so long as you've been through a couple of these declines during your retirement and you see how that works, I think it brings them a lot more peace and they can sleep at night. And I can sleep at night knowing how it's invested too.
Correct.
And that and there is something to be said that some of newer advisors entering, when you've walked beside clients during those time periods and you've witnessed what's happened, it makes it, I don't want to say it's easy, it's more thoughtful, and you can be, more understanding because you've actually been in the trenches with clients during those times, like, so it's a totally different situation.
And just to make sure that, we're clear. It's like, it's okay to make changes.
Yeah.
But you need to make a change for seeking a better outcome, not your like immediate reassurance.
Yeah.
So we've made changes during crises before, but it's pivoting. It's pivoting to take advantage of a situation where I think people are irrational on the other side, meaning the markets, right?
Yeah. You don't want to chase returns.
Correct. Is that change aligned with your long-term goals? That could be important. Are you reacting to information or emotion? And information is not a pundit on the news channel. It's going to be real economic data.
Yeah. Like, our company's still making money from widgets, I mean, are they making money, or are they truly overvalued where, their stock valuations here, but they're putting losses on the books.
Right.
Well, that's overvalued. But if a company is valued here and they're still projecting and making money and they're profitable, well, it's not overvalued potentially.
there's always going to be a future headline, and this podcast, unfortunately, probably won't make a difference because people are going to feel the way they feel. And what I tell everyone here is we should always be empathetic. We should always understand where the clients come from. Don't roll our eyes and go, oh my gosh, this is this, it's another person wanting to sell again, and none of us here act that way.
No.
But you're empathetic and say, I understand. I mean, I'll log in every morning. You log every morning too.
Yep.
And we don't see one account. We see all the accounts.
Yeah. We see where our AUM is, because that's all the values of the client accounts.
On a bad day, $10 million might disappear. And trust me, I can be empathetic because I'm like, holy crap, these numbers move a lot every day as a whole. But then we have to be able to say, okay, well, tell me why you feel this way. And then the why is typically something emotional. And then from there, we say, okay, this is how we built the plan. This is what you're invested in. You're invested in 6,700 stocks, 12,000 bonds. Chances of going to zero are probably there, but a very, very small fraction of percent. If it happened, there's probably a zombie apocalypse or something too happening.
Yeah. I mean, we have bigger problems.
The US has gone out of business, something like that. But then, so from there, it's like, okay, well, we've built this portfolio this way. This is why. And we build our portfolios to withstand a lot of these things, so we don't have to make moves in irrational markets.
Right.
So it's no different than your emergency procedures and flying an airplane. You're not panicking. You're allowed to say, oh, blank for a second. And then after that, you go, okay, well, there's a process for this. Let's work through this process.
Yeah.
And that's very much the same with investing and risk management in general.
And that's our job, is to remind you of the process and what we put in place.
That's the value of a financial advisor. It's not because there's some secret sauce to investing. It's because you have a hotline to somebody that you trust to pick up the phone, and we're going to talk through this and figure this out. But in the end, it's like, oh yeah, you're going to be fine.
Yeah.
Oh, I am going to be fine. Yeah. That's great.
Yeah. Yeah.
Right. That's the value of an advisor. And the people who don't have that, again, another Vanguard study shows they have a lower rate of return because they tend to react to their emotions. They don't have anybody to bounce anything off of. And they tend to go to cash in the worst possible times.
Yeah. Yeah. Which you can't recover from.
No. Yeah. Especially if you're out of it for a long time period. Anyway, thanks for listening to today's episode. If you are interested in learning more about Wiser Wealth Management, I want to schedule a consultation to meet one of our fiduciary financial advisors. You can do so by going to wiserinvestor.com. You can click in the episode notes as well for a link to our website. There's other podcasts out there. We have a Fear, Greed, and the Markets. This is a Mastering Emotional Investing. That's episode 284 and 285. I strongly suggest you listen to those. We dove deep into the psychology of the human mind and why we do what we do. And if you want to learn more about our industry and why people don't always talk the way we do, go buy our book. Everything your financial advisor isn't telling you is available on Amazon.com.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.